Welcome to Renovate Ed, where we talk about all things home and renovation related. Hosted by Jennifer Goldsby, a renovation lending expert. Let's get renovated.
We've been hearing from the experts that interest rates are going to come down. They're going to come down, they're going to come down, and they just keep kicking that can a little further down the road. Rates may or may not come down, and who knows when that will happen. But if you are a homeowner with a mortgage that has an interest rate you would like to refinance should rates come down, I'm going to give you a few suggestions on things that you can do to prepare for that market. When it's a refinance market, lenders are extremely busy. Here's what happens in the mortgage world. We've had an extremely tough market these past 3 years or so. A lot of lenders have downsized. They have let go of staff. They have merged. They've been acquired. They've gone out of business. There is a limit to the amount of work that they could take on. If we were to hit a refi boom overnight and rates were to drop, lenders would be scrambling to hire staff to keep up with the demand. So keep that in mind as we move forward. And just my experience that banks tend to get hit the hardest because they don't usually staff up the way other mortgage lenders do. There's always an exception to the rule, but in my experience, banks move even slower than your independent mortgage bankers or mortgage brokers. So if you're trying to refinance through a bank, you may be sitting and waiting to hear back from somebody. And look, when rates come down, who knows how long they'll stay down. You want to move quickly. You want to lock in your rate. You want to execute very quickly. There is no time to wait. You need to prepare now. So when that does happen, or if that does happen, you can pull the trigger very quickly. You know exactly what lender you're going to go with. You know how to apply online. Let's get ready. Let's prepare. One thing that you can do now to prepare for that later is to clean up your credit. Some would consider this an old school approach to lending, but I would say that even today's modernized automated underwriting systems, they call them AUS, automated underwriting systems. They take the same aspects of a loan application into consideration that we did way back when before we had AUS. They weigh the risk and they determine loan approval, okay? And they do that based on the same criteria that we used to use. I will call it the 4 C's of underwriting. I have heard 3 C's of underwriting, 4 C's of underwriting, 5 C's of underwriting. I'm sure you can find any kind of conflicting information out there on the internet. I'm just going to share with you the way that I was trained, 4 C's of underwriting. That's going to be character or credit. That's 1 C. Collateral, which refers to the property, that's another C. Capacity to repay debt would be a 3rd C. And then capital or cash reserves would be the 4th C. So let's look at each of those and see what you can do now to better your position so that when you're ready to refinance, you can get a quick loan approval. And here's what happens when you go to apply for a mortgage. If you have one of those C's, you're not likely to get approved for a loan. If you have 2 of those C's, strengths in 2 areas or more, you can probably get financing, but your loan is going to have a higher risk tied to it, and that's going to hit the rate. It's going to impact your interest rate. Where we really want to get to is 3 or 4 C's, 3 or 4 strengths in your loan application, outweighing any weaknesses that you might have or eliminating any weaknesses that you might have to secure loan approval at the best interest rate possible. Let's start with credit. Each and every lender is going to have their own loan programs, their minimum credit score requirements. Everybody's going to be a little different on that. I would guess if you have a 620 or higher, you're going to be able to secure financing. But 620 just isn't a great credit score. Even if you can get financing, you're not going to get a very good interest rate. Now, your credit scores are determined by a host of things. Payment history. Do you pay your bills on time? Do you have any collection accounts, any tax liens, judgments? Have you filed bankruptcy? Have you had a foreclosure? All of that's going to weigh into credit score. How many open trade lines do you have? Do you have a ton of them? Everybody's different. I've seen loan applications where someone has 1 or 2 trade lines, their car and their mortgage. I've seen others where they've got 18 trade lines. I've seen some where the bulk of those trade lines are student loans. How many open trade lines do you have? Generally, the more you have, the more your score is going to be hit. What kind of credit history do you have? The longer you've been using credit, the better. And the longer you have a trade line that's been opened, the better. You wouldn't want to close an old trade line where you've been paying on it for some period of time and open up another one because you get 10% off when you go to the cashier to pay for your purchase. Don't want to do that. The longer you've had a trade line open, the better. The longer you've been using credit, the better. Your credit inquiries and new trade lines are both taken into consideration. You really don't want to have a lot of people looking at your credit and pulling your credit, especially in the last 90 days. That could negatively impact your credit score. Although I will say there is a caveat. There is a 45-day window that is available to anybody who is shopping for a mortgage. Once a credit inquiry has been made for a mortgage application, any mortgage lender that pulls your credit within that 45-day window, it all counts as one inquiry. Very cool little caveat for those that are shopping for mortgages, so you don't have to worry about that. But after that 45-day period ends, if somebody else pulls your credit, it starts a whole new 45-day period. So keep that in mind. And lastly, credit is impacted by the types of credit you have. The credit agencies are going to take into consideration the different types of credit accounts you have open. Do you have installment loans? Do you have revolving credit card debt? And so on. Installment loans typically are going to be better, right? Revolving credit debt, especially if you're maxed out or you're over your limit, those are going to be hit really hard. Things are changing in the credit world. For the moment, the mortgage industry is still using the old tri-merge credit report. So we're looking at your credit report from Experian, Equifax, and TransUnion. That may change in times to come. Certainly it will change. This is all subjective, but I would say you have excellent credit if your credit score is 800 or above. I would describe anything in the 720 range to 800 as very good, anything in the 640 range up to 720 as good credit, 580 up to 640 as fair credit, anything below 580 as poor. That's all subjective. It's just my opinion. After 20-some years in the mortgage industry, I'm sure other loan officers or lenders would have differing opinions. But just to give you kind of a little scale to help you identify where you might land. Now, what are some ways that you can improve your credit? Well, first things first, you really should get a copy of your credit report now. If you're not doing this every year, you need to start doing this every year. Once a year, you have the ability to pull your credit from all three bureaus for free through annualcreditreport.com. That is the only federally approved method to pull your credit report for free once every year. Yes, there are some other companies that will give you access to your credit, but they tend to charge you fees for various credit services, credit monitoring, credit repair. So be aware of any imposters, any gimmicks. Go to annualcreditreport.com. That will get you your credit report free once every year. So first things first, get a copy of your credit report. Look at it. Are there any inaccuracies? If there are, you need to dispute those. Make sure that your payments are all made on time. If you have revolving debt, you're carrying credit cards, I recommend that you pay those down to 30% of their limit or less. I'm just going to use really simple numbers here. If you've got a credit card with a limit of 10 grand, you never want to have anything more than $3,000 on that at any given time. If you have collection accounts, pay those off. Reduce the number of open trade lines that you have. I know it's so tempting to take that 10% off offer when you go to that cashier and you go to checkout, but you need to be aware of the consequences, especially if you're thinking about refinancing in the near future. And then qualifying is only half the battle. Your credit score determines your rate. Generally speaking, the higher your score, the lower your rate. I will tell you in recent times, especially with conventional loans, that's not always necessarily true. It does also factor in the equity that you have in your home, for example. But in general, you're going to want to take really good care of your credit so that not only you qualify when you go to refinance, but you can obtain the best interest rate that's available as well. Let's move on to the next C, collateral. This is a reference to your property. That property needs to be in good condition. Should not be able to visibly see any health or safety concerns or structural issues. If those exist, yes, you can still refinance. You might consider using a renovation loan, but ideally you want to keep your property in great condition so an appraiser, when they're walking through, isn't seeing any kind of health or safety issues or anything structural in nature. If that's true, you've got a strength in that area. Not only that, but a strength in that area would be if you have a lot of equity in the property. I think that's subjective to 20% equity would be plenty. If you have more equity than that, even better. If you have less equity than that, it's not necessarily a bad thing. There are lots of different loans that are out there that are available, lots of different ways to refinance, but having some equity in the property is going to be key, because when you refinance, ideally, most people are going to want to include their closing costs and any prepaid items like homeowners insurance or interest due at closing, and they're not going to want to come to closing with cash out of pocket. And that brings up a really good point. There are some streamlined refinance options that are available that allow you to refinance the principal balance of your loan, but would not allow you to roll in closing costs and prepaids. So if you opt for that type of a refinance, you're going to be bringing some cash to close. So let's talk about that C of underwriting, capital or cash reserves. Liquid assets are going to be a strength if you go to apply. We're going to see that on your loan application. So if you've got any kind of assets in a checking account or a savings account or CDs, money market, etc., you can also use retirement funds as cash reserves. The more you have, the stronger that particular C is in underwriting. And if you do need to bring any cash to close, let's say you're doing a streamlined refinance and you need to bring, I don't know, we'll call it $5,500 to close. If that liquidates all of your cash reserves, you no longer have a strength in that area of your loan application. So if you're someone who would qualify for a streamlined refinance and you're preparing to refinance down the line, you're going to want to start saving now so that you have the money you need for closing and then still have some money left over in cash reserves. That way you've got a strength in that particular area of your loan application. And lastly, let's talk about capacity to repay debt. That's the final C we'll talk about today. That is measured by something called debt to income ratio, or DTI ratio. It's going to take into consideration your housing debt on the front end and then all of your debt on the back end. They call those the front end ratio, the back end ratio, or total debt ratio. And it's really up to your loan officer to do that math. I'm not going to try to explain all that to you, but your housing ratio, your front end ratio, it's not just your mortgage payment. It's going to be your mortgage payment, including principal and interest, any kind of mortgage insurance that you're required to pay, property taxes, homeowners insurance, flood insurance, et cetera, homeowners or condo association dues. We take it all into consideration. And then your total debt ratio will include all of your housing expenses. Now, we're not talking about utilities, water bills, gas bills, electric bills, trash, that sort of thing. But your total debt ratio is going to take in your housing expenses and add that to all of your monthly obligations as we would see on a credit report. So credit cards, auto loans, student loans, et cetera. And underwriters are going to use that, or the automated underwriting systems are going to use that to determine if you have a strength or a weakness. If you have a really high ratio, that is not a good thing. If you got a really low one, that's a great thing. And for every loan type, there's a different level of acceptability with this DTI factor. It varies loan to loan to loan. So conventional loans are going to look different than FHA loans or VA loans. Every loan is a little different. Boy, I'd love to give you some examples of what would be acceptable, but it just varies. And it doesn't just vary loan to loan to loan or loan type to loan type, but it also varies according to your circumstances. If you have really strong areas of your loan application, you've got strengths in equity, ton of equity, you've got lots of cash reserves, but your DTI is a little on the high end, you may still get approved, and you may still get approved for the best rate that's available. It's a little subjective. All of that varies depending on risk appetite. So that's something I can't give you a whole lot of guidance on, other than to say it's going to be better if you have less debt, if you carry less debt in comparison with your gross monthly income. Hopefully these suggestions are going to help you to prepare, get your financial house in order so that when rates do come down, you have the ability to refinance. But I would go a step further and not just take care of yourself, but also to establish a relationship with a lender that you trust so you know when those rates come down exactly where you're going. You can go online usually and apply and do that very quickly. That way your loan application is front of the pack, because lenders, they're going to get bombarded with refinance activity if rates come down. and you don't want to be in a position where you miss out on that opportunity if it's short term.
Now the legalese required to appease attorneys, compliance officers, and regulators. This podcast is hosted by Jennifer Goldsby, NMLS number 591226, Vice President, Renovation Lending. The topics discussed herein reflect my personal opinion. They do not represent the opinions of Diamond Residential Mortgage Corporation and its management. Discussions about loan programs in this podcast are not a commitment to make a loan. Programs, approvals, rates, fees, and loan terms are subject to loan applications, credit risk, appraisal evaluation, underwriting guidelines, and other lending or qualification criteria and limitations, and are subject to change without notice. Not all products are available in all states. Not all borrowers will qualify. Diamond Residential Mortgage Corporation, 582 Oakwood Avenue, Lake Forest, Illinois, 60045 847-244-9301. NMLS number 186805. For licensing information, go to nmlsconsumeraccess.org/entity-details.aspx/company/186805. Equal housing opportunity. Diamond Residential Mortgage Corporation is not affiliated with or acting on behalf of or at the direction of FHA, VA, USDA, Fannie Mae, Freddie Mac, or any governmental body or agency.